Okay, welcome everybody. Thanks for joining. You ready there, John? So thanks everyone for joining
You're on board.
for our cash flow fundamentals, why cash is king and how to manage it webinar today. So we are Quantum Advisory. For those of you who don't know us, my name is Patrick Connolly and I'm presenting today with Jonathan Tiefel. We're both senior managers in business services here at Quantum. And at Quantum Advisory, we are accountants that help you define your next level and how to achieve it. We primarily work with businesses in the construction, manufacturing and wholesale industries. We've got a team of 26 and we've got offices in Penrith, Wollongong and Lithgow. So we're here today to talk about cash flow fundamentals. Especially in those industries, the people we work with, it is consistently the #1 concern that business owners raise with us is how to improve cash flow. It's the biggest problem you can have is a cash flow problem. But even for those businesses that don't have a specific cash flow problem right now, by improving your cash flow model, you are obviously increasing the value of your business. So I think it's a really important topic for us to focus on today. So we're going to run through first, why cash is king. Then where did my profits go? Understanding your working capital, 3F approach to cash flow, how to survive a cash flow crisis, and your cash flow action plan. And we will have a section at the end of this for questions. And we're also going to send everybody a copy of our 13-week cash flow forecast, which we'll go through later. So John, did you want to tell us first, why is cash king?
Thanks, Pat. That's a good overview. And yeah, hang in there for that 13-week forecast, because you'll find that very valuable. So I guess the main thing we really want to focus on today is the fact that cash in business equals liquidity. And we just really need to focus on how important liquidity is. So liquidity gives you options. So at absolute worst case, good cash reserves will minimize the impact of a cash flow crisis. And I think one thing we saw with things such as the COVID-19 pandemic was impacts on different industries that really sorted the sheep from the goats as to who had their cash machine well oiled. And one thing that we saw consistently across our client base is that clients that were managing cash effectively could also take advantage of a whole heap of opportunities that others possibly may have missed. And the other thing we really need to focus on here as well is what Pat's mentioned around what it does to the overall value of a business. So obviously, if you're an investor looking at a business, you're not really going to be looking at the vanity metrics of revenue and the size of the operation. What you really want to be focused on is how well the business is generating cash and free cash flow. So just wanted to start off with a good solid couple of scare statistics there. So 82% of business failures in Australia are due to poor and irregular cash flow. And that's not specifically Australia, that's consistent right across the globe. It's poor cash management is always pretty well in every case the result of business failure. And the other one here is interesting as well, and that's 44% of businesses are dependent on a credit facility to fund daily operations. So while they may not necessarily be a failing business, they're dependent on a credit facility. And this really, once again, highlights the importance of solid cash flow management. So,
Terrifying statistics. Well done, John.
Yeah, so hopefully everyone's significantly scared. And I guess just to get back to the old saying, which many would have heard before, but that is revenue is vanity, profit is sanity, and cash is king. So I guess the point we want to make here is revenue, unfortunately, doesn't pay the bills. It's cash in the bank that does that. And while you may have a profitable business, at least on paper, that's not necessarily enough. What really matters at the end of the day is cash in the bank. So, you know, your business maybe have a very good top line revenue, may have good profits on paper. But then if you're in that situation, you might be wondering, where's the profit gone at the end of the day? So fortunately, we've got Pat here to take us through exactly that.
Yeah, so it is actually a really common question is, where did my profits go? And it's often not asked exactly like that. It'll be that we'll sit down at the end of the year and with a set of reports and an explanation of how much tax is payable. And a business owner will say to me, well, you're telling me I made all this profit, but I haven't got any cash. What happened to that? So I've got a couple of examples here to show how important working capital is in that conversation. So we start off with a fairly profitable business. It's got revenue of $100. It's got cost of goods sold of $60. So it's got a GP of $40, 40% GP, pretty good. overheads maybe a nudge high at $27.50, but we've still got operating profit of $12.50 or 12.5%. So perfectly respectable numbers. After interest and tax, we're down to $9. So for a $100 sale, we should have an extra $9 at the end of the day. That's what we're saying. Now let's look at the cash flow impact. So we've modeled this first on a business with accounts receivable days of 30, inventory days of 90, accounts payable days of 90. So this is a business that has solid GP and very reasonable cash flow metrics. When it sells $100 of goods, it's going to invest $8.22 in accounts receivable. It's going to invest $16.03 in stock, but it's going to be offset by accounts payable increase of $16.03. So to sell $100 of products, which we know is going to end up with $9, we need working capital of $8.22. So we've got a surplus of 78 cents. So even with very healthy margins there, you can see in the short term, it's not generating huge amounts of cash. If we were going to make a change here to any one of those levers, whether that's GP or any of the working capital metrics, you can see what happens. So here we've kept all the debtor, inventory and credit days the same, but we've increased the cost of goods sold by 2.5%. So we've still got margin of 37.5%, still very respectable. We've still got, okay profit at 6.5% net profit. But with that change, we've now got a cash shortfall of $1.72 in the short term because of the extra investment in working capital that's going to be required.
For a price increase, Pat?
Yeah, well, that's an option, but we're trying to fix the working capital at the moment. So if we take that a step further and go back to the original plan, and then we say, let's not touch the GP, but let's instead, we can actually get better GP by buying in bigger quantities, we've discovered. So we've discovered we can reduce our cost of goods sold by $1. So reduce that to 59%, increase our gross margin to 41%, increase our profit to $13.50 or 13.5%, and our net profit to 10%. However, to do so, we need to increase our inventory days to 120. That's going to require an extra $21.37 investment in inventory, which means that our total investment of working capital to get that sale was $13.56. And we've actually ended up with a shortfall of $3.56. So we've increased our profitability. We've got a great deal, but we still ended up with even less cash. And that just shows how important it is to focus not just on the P&L, but also on the balance sheet. So to take that a step further and have a look at what's involved in working capital. This shows us the cycle of what your cash does in the business. So quite simple, really. You're using your cash to purchase stock, pay suppliers, sell the stock, get paid by debtors. So your cash goes from you to your suppliers, and then you get it back from your customers. And the length and what's involved in that cycle can have a huge impact on how successful your business is. So starting off with some of the key metrics here that I've already mentioned, debtor days. So just to go back to basics for a minute, your debtor days are a measure of how many days of your average sales you have sitting waiting in debtors waiting to be collected. So we calculate that by looking at your total debtors balance divided by your total revenue times 365. So for example, if you're a business that turns over $1 million and you've got, say $500,000 sitting in debtors, you've got 6 months worth of the year, so half the year, so 6 months worth of debtor days. And what we're saying is you've got 6 months worth of debtors there to collect. Next metric there is creditor days. Broadly a similar concept. We're looking at what your total balance of your creditors is and comparing that to what your total spend is on COGS throughout the year. So, and working out therefore how many days worth of creditors you have sitting there waiting to be paid. It's calculated by taking your creditors balance and dividing it by your annual COGS. So if we take that same business, which had $1 million turnover, and we say it's got a margin of 20%, so its annual COGS is 800,000, and it's got 200,000 sitting in creditors, then it's got 1 quarter, so 3 months or 90 debtor days, 90 creditor days sitting on the balance sheet at any time. And then looking at inventory days, again, a very similar concept. It's how many days worth of stock do you have based on your cost of goods sold and your average sales. This one's calculated by taking your inventory balance divided by your annual COGS. So that same business, let's say the inventory balance of 400,000, we know that the annual COGS was 800,000. So therefore we've got 6 months worth of inventory or 182 days. when we put all those together, working capital days, and that's the combination of those three metrics we just spoke about. So it's looking at your inventory days, plus your debtor days minus your creditor days. And what we're really saying is that on day 0, you've gone and ordered your stock. In our example, we had 6 months of stock and 3 months of creditors. So day 0, we ordered our stock. At 90 days, we had to pay for that stock because we've only got 90 days worth of creditors on our balance sheet. So we paid for it on day 90. We sold the stock on day 182, and then we got paid for the stock another 6 months after that, so another 182 days. So between day 365 and day 90, we funded that stock the whole time. That was what the amount of time that our cash was sitting with our supplier before we got it back from our customer. So obviously you can see the shorter you can make that, the less cash you have to have invested in the business, which obviously makes cash flow a lot smoother, but also from an investor's point of view, looking at your business and they're saying, well, if I was to buy that or invest in that, I know that I've got to have, the difference between having 2 or 3 months worth of working capital or having 9 months worth of working capital invested makes a big difference to the value of the business and the return that somebody can get.
Yeah, so I guess what we wanted to do now is just run through some generic points as to the different aspects of the working capital cycle and how we can reduce the overall. As Pat just very helpfully ran through, our main aim is to reduce that whole cycle so that anytime the business spends money, it's recovering that money plus a profit margin a whole heap quicker. So when we discuss how we can directly impact these metrics, it's important to note, quick disclaimer there, that obviously every business is different and the advice we're giving here is generic, but a couple of things we really wanted to focus on here. So when it comes to specifically decreasing debtor days, first thing that every business needs is a very robust accounts receivable policy that everyone, particularly the accounts team, needs to know. So what are your credit terms? Who do you give credit to? And then also what's your policy then for following up outstanding payments, when to stop credit kick in, if it does at all, and making sure that's clearly documented and not just documented but followed. There are a few tools out there, without turning this into a tech talk, there are a few tools out there that will help automate that. So that could be something to explore. Your Debtor Daddies, Easy Collects of the world spring to mind. The other thing that business should be doing, particularly if they're taking on a large new account, is credit checks. So making sure that they've got a track record that justifies the credit terms you're going to give them. The other thing you could be looking at from an overall strategic perspective is your pricing structure and payment schedules. So looking at whether you can receive any down payment or upfront price deposit for the work you're doing. If you're operating a larger project type business where there's a payment schedule, looking at whether you can increase the regularity with which the customers are paying. Another idea out there is around invoice financing. Now it's not ideal, and it takes a lot of sort of financial nuance to make sure that works effectively. But if you're using it to flatten out the peaks and troughs, it can work. Our main misgiving there is that it tends to trip over the cash flow cycle that we've just discussed. And if poor cash flow is a symptom of some more deep-rooted issues, then all that invoice financing really does is just masks the issue and then compounds it later down the track. But I guess the final thing that we really want to stress here, and Pat will join me here, I don't think we can stress this enough, is don't offer early payment discounts. That's pretty well your most expensive form of finance. We've got some other resources on this. There's some stuff on the website about it, but just don't. Is that fair, Pat?
Just don't do it. That's right. It's I think people give a few percent early payment discounts to get their money a month early, and you annualize that for them, and they realize what kind of finance cost they're incurring, and that stuff are pretty quick.
Yeah, and it's pretty insulting to the sales team who've stretched to get margin and procurement who've sort of purchased aggressively to then go and let that go with an early payment discount. So how can you increase creditor days? So this one can be a bit more challenging. The obvious one here is negotiating payment terms. So at least just asking the question. And if you're in a situation where a supplier won't increase payment terms, obviously shopping around. If there's a comparable product with better payment terms and there's a quantifiable impact on your cash conversion cycle, then it could be worth exploring other suppliers. And the other thing that we've seen particularly effective is when clients will take a facts-based approach to negotiations. So if you can go along, particularly if you know you're a key customer to a certain supplier, if you can go along and say, well, look, our spend with you has gone from 40,000 in year 1 to 400,000 in year 2 to $1 million in year 3, and this is what our forecasted spend with you is going to be over the next 1 to 2 years. If you can put it out visually for them, exactly what your spend means to them, it can be a lot better place to come from in terms of negotiation, particularly if you know you're a fairly key customer to them. And then finally here, we really need to be treating suppliers as key partners. So communicating with them, checking in with them, just as you would with any other stakeholder in the business, but a key customer. You really need to be making sure that suppliers understand your overall business strategy and where you're headed in the market, and making sure you've got a very good working relationship with them. So if you do need to lean on them, or you do want to open that discussion around negotiating payment terms, that you've got a bit more reputation there to leverage. And finally, how can you decrease inventory days? And this is another big one, and it obviously depends a lot on what you're selling and what you're doing and what stock you're holding. But one thing that's crucial, regardless of what you're doing, is active inventory management. So inventory management that's accurate and ideally gives you the ability to forecast based on what your sales pipeline is looking like, so that you're not taking a thumb in the wind approach to securing inventory, but you're running a lean as ship as possible. You also need a process in place for dealing with slow and obsolete stock. So anything that's not moving as fast as you'd like, what's our process for getting rid of that? Whether we're trying to bundle that with faster moving items, or whether we've got some other way of moving that via an online store or sub-brand or something like that. And also analysing what we're stocking, ensuring that that's high GP or core products to our service offering, and not really stocking anything that we don't need to. If
you've got to be pretty brutal about that, don't you? In terms of trying to take the emotion out of that decision and look at some numbers analysis of what's actually selling, and then be honest with yourself about what range actually is required to support it.
Yeah, absolutely. That's excellent, Pat. So I guess we've run through some fairly high level things there. Obviously, an approach needs to be fairly bespoke to a specific business, but that's something to get you started, I guess, until we can discuss that in more depth. But until then, I'll hand back over to Pat to take us through the 3F approach to cash flow.
Thanks, John. So our 3F approach to cash flow is to focus on forecasting, funding, and focus. So starting with forecasting first. So obviously forecasting is the backbone of any good cash flow management system. You can't do any of this without a forecast. There's two main types of forecasts, and they serve slightly different purposes. So first, you've got your short-term cash flow forecast, and this is anything from a 4-week to a 13-week forecast we would consider short-term. It essentially is focusing on things that really are already known. You should be able to know with some degree of certainty over the next few weeks what cash inflows and outflows you're going to have. And we would encourage people just to start with the big things first. It doesn't have to be perfect. A short-term cash flow forecast should be as accurate as possible, but it can be overwhelming. So focus on the big items, payroll, sales that are coming in, large credit bills going out, and just tracking out those things over the next, like I said, 4 to 13 weeks. That should be able to highlight to you any immediate term issues you're going to have, and it's just giving you comfort you've got cash day to day to keep going. That kind of forecast needs to be looked at, at least weekly. If there's any issues with short-term cash flow, it needs to be looked at probably more often than weekly. But every business should be running a short-term cash flow forecast that's regularly updated with any changing assumptions, and it's looked at weekly to make sure it's still current and correct. That can also identify for you anything you're missing out of your forecast if you're looking at that weekly and seeing a big difference to where you projected you're going to be. The other sort of forecasting obviously is long-term forecasting, and this is looking to that 13 to 12 month period, 13 week, sorry, to 12 month period. This is forecasting on a a larger scale. More of this is obviously unknown. This is a lot more assumptions based, but it looks at, you should be looking at a three-way forecast that looks at your profit and loss, your balance sheet, and what that does for your cash flow. So projecting out what you expect to happen from a P&L perspective, what you expect to happen from a balance sheet perspective with those three items of working capital we've been speaking about, and then giving you a projection of what that does to cash flow. That kind of forecast, a long-term forecast, won't ever be super accurate, but the idea of it is simply to illustrate any peaks and troughs in cash flow, to identify ahead of time that following a certain plan is going to mean that, you know, in this month you're going to have a cash flow need that needs to be a gap that needs to be plugged, and you should be able to plug it by this point in time, and making sure that the plan you're making for the year ahead actually works and stacks up. So we've got a couple of tools for that. I'll give you an example next of a 13-week cash flow forecast. If you want to jump to the, you jumped, good. So this is a 13-week cash flow forecast template. We're actually going to send this out to everybody after this webinar. You can see it's very simple. It's generally a one-pager, just has debtor receipts in, other cash in, and then lists your main sources of cash out. And it's very simple, just cash in, cash out week by week. You just go ahead and plot your numbers in. Like I said, you want to look at this every week to make sure it's still accurate and nothing's missing. So this is what we're going to send out to everybody at the conclusion. This one on the screen now is our long-term forecast. Feel free also to ask us about this one. We can give you a template. We could also potentially give you some help with this. This long-term forecast is a three-way forecast, has the ability to set assumptions around debtor days, creditor days, inventory days, forecast your P&L, and then spit out a cash flow forecast, which tells you what that's going to look like over the year ahead. It's also, this is the one that's going to identify for you the funding needs you might have.
As you say, Pat, and it may not ever be perfect, but it definitely takes that element of surprise out, doesn't it? So that if there is a cash flow bit of a crunch, at least you've seen that coming well in advance. It may not be to the dollar, but at least you know.
Yep, that's right. So the three golden rules of cash flow forecasting: keep it alive. So your forecast will be out of date almost immediately as soon as you've done it. There's going to be something wrong with it. Roll it over every month, but preferably every week. And if you've got issues, like I said, more often than that. Success, not perfection. So just make a start and refine it as you go. Don't put every little thing in there. Don't put too much detail. Keep it high level. You've always got to remember when you're doing any sort of forecasting and reporting, the whole point of the exercise is to give you information to make decisions. So if the information is not going to be material or relevant to any decision-making process, it's not relevant. And stay close to the numbers. So it's difficult for anyone external to do this effectively. It's got to be a key person in the business. And anybody with any responsibility for the business needs to be certain that they know what's happening in terms of their cash flow. So our second F is funding. So a few notes here about funding. So don't starve your business. So any cash flow that is too restrictive will limit your options. You obviously don't want to have an abundance of cash either in your business. You want to be operating efficiently, but you do need to make sure you're not starving the business. Your funding options always come down to the same two: debt and equity. So we'll be focusing on debt funding for most of this because we aren't talking about cash flow today. So your bank manager is your friend. A crisis is not the time to introduce yourself to the bank manager. You don't want to be going and meeting your bank manager the first time when you need something from them. Far better to be meeting them now, well in advance of any problems, and develop a relationship with your bank manager. Once you've got a relationship, once they understand your business and what you're about and where you're going, they're far more likely to be able to help you when you need help. But also it's good to be having those discussions when you don't need help and setting up the facilities for when you do need help as well. But also ask the hard questions. So I guess the point here is that your bank manager is a supplier, like any other supplier. That balance of power in that relationship is often a bit different to other supplier relationships, in that it can feel like the bank has a lot more power. But remember that they're one of many, many banks that could help you. You're a business owner. You're giving them a lot of revenue for your bank fees and merchant fees and everything else you're doing with them. They don't want to lose your business. So you need to be prepared to push back and also be prepared to walk away and see what your options are as well. And then the third F is focus. And so this is really I guess the point here is that as management teams, when we talk to clients, often the management team is fully across the profit and loss statement, and all their KPIs are around profitability. And obviously we're all in business to make profit, that's the whole point. And so it makes sense that that's the main focus of the management team. However, as per Jonathan's scary statistics before and many other lessons we've learned over time, cash flow is just as important as profitability. There's no point having a profitable business that fails because of poor cash flow. That's not going to give you any return either. So it needs to be a KPI of the management team to be reviewing debtor days, to look at inventory days, to look at creditor days. All of that working capital needs to be a management team priority and KPI so that everybody's working towards the same goals. And I think the point here, focus on low-hanging fruit, what we're saying is we've just gone through a whole lot of different strategies available for each of those levers in cash flow. The suggestion here is just spend some time on focusing on what's required to improve. Look at, in each of those categories, what's some obvious things we could do right now and do those. Just go and look at, are our debtor days too high, and could some AR policies really quickly and simply fix some of that? Have we not ever analysed our stock, and is there some stock we could quite quickly offload that would make that better? So looking at the simple and easy things that could be done right now to improve the business.
So it's really measuring the cash impact of things, do you think, Pat? And just focusing on what's going to give us the most bang for a buck.
Exactly. Yep. And then once we've done the low-hanging fruit, that's when we start looking at the long-term fundamentals, building in those KPIs into the management team, making sure that it is one of our key focus areas as we move forward, that we're looking at every month profit, debtor days, creditor days, inventory days, and improving the value of our business that way.
Do you think, just to circle back, what do you think it is, Pat, that business owners don't have the focus on profitability, but not on cash flow? I've spoken to a couple of business owners now that have sort of switched their dividend policy and sort of their profit share models away from profit and focus that more on cash. Do you think that could be an effective leverage? Yeah,
absolutely. I guess every business is different. We obviously deal with a lot of businesses that do wholesaling or merchandising, and it's not uncommon to see a business that has grown immensely, quite quickly over 3 or 4 years, big profit every year, but there's never any cash. And there's never any cash because as they're growing their profit, their stock is just growing with them to be able to service a bigger and bigger and bigger client base. And in that situation, it doesn't make much sense to be paying dividends or rewarding profit share when there's no cash being generated. So I think, like you said, it's a conversation worth having. It depends on your business model. So John, how do we survive a cash flow crisis?
Yeah, so I guess we wanted to include this section. Well aware that some may have joined the call today just because they are feeling a pinch. Also, none of us really know what 2023 holds in store. And if there is a situation where a curveball does hit, exactly what do you do if cash becomes very tight and the 13-week forecast shows that things are going to be a struggle. First one, very much a statement of the obvious, but I guess we just have to emphasize this, and that is don't panic. So often we'll see after the fact that business owners have panicked when cash flow has been tight and made a bad strategic decision or something that isn't facts-based. That's largely been based on a gut feel. So I guess that leads into the next point, which is get the facts. So speak to your accountant, speak to your accounts team, and get a few things very, very clear. Firstly, who owes you what, exactly what your debtor's balance is, who owes you money, when can we expect to see that, who do you owe money, and when do you expect to see that by, what are your short-term cash commitments, what overheads have you committed to and can't be avoided, and also exactly what cash you have available, whether that's equity, whether that's funds outside the business, or whether that's any funds available via a credit facility through your bank, etc. But get some very clear dollar signs around what all those numbers are. And another piece to this is communication. So communicating with everybody, communicating with the team, especially the management team, absolutely, but the rest of the team. Make sure you're communicating with customers and making sure that your expectations around when they'll be paying are very clear. Also communicating with your suppliers. It was interesting over the COVID crisis, some of the success that we saw some of our clients have had via over communicating, particularly the ones that were forecasting and knew when there was going to be a problem. It can be seen as a bit of a sign of weakness to go to a supplier and say, we may need better terms. We're in a bit of a difficult situation. But one client springs to mind where they went to one of their key suppliers and said, look, we've done our forecasting. We know this is going to be rough over the next couple of weeks. Can we establish a plan where we pay you X amount, and gave them specific amounts they're going to pay in specific dates. And while they'd put a lot of their customers on stop credit, they end up being very flexible with this client in particular, just purely to the fact that they could clearly articulate where they were at from a business perspective, and they sort of demonstrated solid financial acumen that they knew exactly what their cash position was going to look like, and yeah, obviously communicating with key people internally as well. And then I guess just a general reminder there too around tightening the screws. So particularly around accounts receivable. So getting very tight, very tightly managing any overdue accounts. Also tightening the screws on inventory management. So getting very, very focused on what's moving and what isn't. And then also overhead. So going through line by line at the end of the day, any money that's going out in business should only be to generate more money coming in. So going through and just looking at wherever there's any wastage there, and cutting that off. And as part of that, I think we need to be prepared to make some tough decisions. So if it gets to a point where some tough decisions need to be made, there needs to be some science behind that. There could be that we need to sort of turn off the tap to some areas that aren't delivering, whether that's departments or people. One thing that we've said to clients before is that they really need to establish a hit list. So if they were to strategically isolate the core of their business and what's required to fund that, then looking at in reverse order, what would we switch off if we had to? So if it gets to that point, and also the forecast helps a lot with that, because we know that if we get to this position and we can't afford to keep X, Y, and Z expense item, exactly when do we switch that off? So I guess it's just taking all the emotion out of it and getting back to facts and data, which I guess really brings us to our cash flow action plan. So where to from here? So there's a few things that anyone on the call today really needs to take away from this.
Just before you jump into that, John, I'll just say we've got a few questions in the Q&A. We are coming towards the end of our webinar, so if anyone else wants to chuck questions in, feel free while we're talking. Sorry, John.
Awesome. Yep. No, we'll get to that. Get to that shortly. We just really want to stress that anyone on the call today takes away there's 7 points as their cash flow action plan. So the first thing is to understand your cash conversion cycle. So if that's not something you're actively measuring, as Pat ran through before, it is a fairly straightforward calculation. So make sure you're on top of that. It's a very powerful thing with very tangible outcomes. Next is to set up your short-term cash flow forecast. As I said, we will be sending around a template, so by all means use that and make a start. So don't put that off. Just make a start with that. Point 3 there is to meet with your bank manager. So I guess the best time to have the conversation with your bank manager around what your commitment's going to be was sort of when you started the business. But the second best time is now. So give them a call. Don't wait until they've got you over a barrel and you're in a desperate situation. Investigate alternative funding. So as Pat said before, you're not a hostage to your bank. Maybe take a look at what else is out there and what other competitive options on the market. Review the data management process. So take a look at exactly how you're getting paid and anywhere that could be tweaked or optimized to really reduce those accounts receivable days. Conduct an inventory analysis. So get very clear what's moving and what's not. And point 7 there is negotiate payment terms with suppliers. So if you don't ask, you don't get. So that could just be as simple as just opening the conversation, just asking the question, yeah, what can you be doing for us? And that really brings us to the end. But as Pat said, yeah, the questions are coming in thick and fast. So yeah, if anyone's got any questions, please throw them in the Q&A box, and we'll get to those. We'll get to those now. Okay, so first cap off the rank, Pat. How does other creditors such as utilities or insurance, etc., affect the creditor days, since the creditor balance is increased, but days are measured against COGS, which does not include utilities, etc.?
Yeah, it's quite a valid point. Obviously, creditors include some things that are in overheads. As a general rule, overheads are not staying in creditors very long. You don't have too many overheads that allow you to pay anything more than current month. But it is true that if you just take the creditor balance as per the formula we showed on the slide, that is not perfect. Some ERPs will give you that perfectly by separating creditors that relate to cost of goods sold versus creditors that relate to overheads. That's a better statistic if your software does that. That's quite specialized software to be able to get that information. But I think the important thing is with any of these metrics to track the trend rather than the exact number, because any of these exact numbers are taken on one particular day. So if I run the creditor days on 31 December, it's literally what was the creditor's balance on 31 December. It doesn't matter if we paid a massive bill on the 1st of January, the number would be totally different. So any of these numbers, they don't need to be perfect. What needs to be tracked is the trend.
Yeah, so as you say, Pat, the trend's important. Also, the overheads, we're working at a fairly fixed base, aren't we? So I guess what we're really focusing there is the I guess what's above the line and working capital. So yeah, while it is going to impact it, just to strengthen what you say there, Pat, the important thing is the trend's heading in the right direction.
Yep.
Another question here, can I have a copy of the forecasting spreadsheet? Absolutely. The short-term one we'll be sending out.
That does not count as an answer, John, by the way. You're taking another question.
So but if you do want a copy of the more comprehensive one, please reach out to us, and we can discuss that. That one is a little bit more complex, so you might want a bit of a hand through that one.
All right, John, do you have any tips for forecasting for a project-based operation? Seems to be more of a challenge to keep on top of this versus a typical accounting entity.
Yeah, absolutely. And yeah, brilliant question. Some of the project based clients we work with really struggle with this, and the bad news is there isn't a silver bullet, but the main thing is that one of the key things we've found here is to include the whole team. So if you've got so it's in a project-based business, finance can't really do this in isolation. They really need to get project managers involved. They really need to get the operations team involved to know exactly when a project will be at a position where it can be invoiced again and exactly what costs are expected to be incurred. The main takeaway there is that finance can't do that in isolation. So sometimes that will require pushing a bit more financial accountability down to the project managers to say, okay, well, exactly at what point can we put in a progress claim for this? And then the other main takeaway there is to make sure, as Pat said earlier, that we're kept very close to the numbers, so that this is something that's reviewed very frequently, so that if something does blow out or there is unexpected project delays, that they're seen well in advance. Anything to add there, Pat? Or?
No, I think the main thing though is I think it's a good point in the question that a lot of those key metrics we spoke about, debtor days, creditor days, inventory days, debtor days is just as relevant. Some of the other metrics are not quite as relevant to project-based businesses. So it really comes down to your main tool being your short and long-term cash flow forecast, like you were saying, and making sure that we get that as accurate as we can. Yeah.
Another interesting one here, Pat, on a technicality, and that is, should the equations include GST?
Should the equations, well, you should make sure that both sides of the equation are either GST inclusive or exclusive. Yeah, so you should compare GST inclusive debtors with GST inclusive sales. Yep.
So I think with our internal KPI reporting, we add GST back to the sales for that equation. But the main thing to make sure is that if debtors or creditors include GST, that your overall COGS or sales include GST as well.
So there's one here that I've accidentally moved, John, to the other section, but it says here, as a rule of thumb, should we be aiming to have a certain value of cash reserves, for example, 6 months of fixed costs? So I think my answer to that would be that it's obviously different for different businesses based on your, I guess, tolerance of risk. Having said that, I think 6 months of fixed cost is a lot to have in cash. I can't foresee a situation where you're going to go 6 months without any revenue. I think a better metric than cash cover days is probably the quick ratio. So the quick ratio looks at all your current assets except stock and compares that to the value of your current liabilities. So you'd like that to be about 1, which is saying that for every dollar of current assets, excluding stock, we've got about $1 of current liabilities. Anything lower than 1 means that if it all came to a crunch, you couldn't quite pay everyone. Anything higher than 2 suggests that you've got a lot of cash, it's quite lazy and not getting much of a return. So that's sort of how I would approach that one, is to look at the quick ratio and even the current ratio, but try and keep that quick ratio between 1 and 2.
With so we do, as in, it is definitely a feel good metric, particularly to business owners that are risk adverse. That said, for some of the clients I've worked with who are in that situation where they do want they want the sort of security of some sort of cash cover, we've never really wanted to see that go beyond 90 days. But the only other factor there is that if some banks will factor in cash cover, as in they just like to see that the business is being run conservatively. That said, though, if as Pat said, if we starting to see too much cash lying around, then it's suggesting that we're sort of missing valuable opportunities. Either that cash could be pulled out of the business and used personally, or it should be reinvested back into the business. Which I guess just leverages another point that if businesses are accurately tracking other financial metrics such as return on investment, etc., then they should know what they should be reinvesting back into the business as opposed to pulling out.
Yep. Good.
So there's another question here, Pat. For a wholesale business, what's a good benchmark to aim for stock days? Obviously, we want to bring this down as much as possible. However, at the same time, ensure room for growth, brackets, don't run out of stock.
Yeah, so I think two things to that question. First is you can't actually look at stock days in isolation from creditor days and debtor days, because what you're really trying to, if you want to have a best practice to aim for, it's really got to be look about working capital days, about how much, and that comes back to how much cash you have to have in the business. But to get to that question, because it does come up a lot, I would normally answer that by saying you need to look at your lead times. It's very different for a business that's buying from Australia and can get more stock in 2 weeks versus someone who's importing and has a 3-month turnaround time. But if you were to take the average lead time on your products and weighted average based on what you're selling the most, that would give you a pretty good idea of where you want your stock days to sit. So if on average it takes you 90 days to get more stock, then you'd want to have a little bit more stock than 90 days. You wouldn't want to have 180 days sitting in stock, because it's just money sitting on the shelf that you didn't need to have sitting on the shelf yet. Do you agree, John?
Yeah, absolutely. And I think the other important thing to say there is that sometimes there can be a strategic reason as for why one of these numbers may be well above or below the norm. I know one of my clients, for example, their sort of niche or their USP in the market is the fact that they carry a lot of stock, as in they have everything in stock, and their turnaround time and delivery times is sort of what sets them apart. So as a result, their inventory days are massive because they're obviously carrying a lot of stock. In fact, they're carrying a lot that they don't turn around quickly, but you know, they want to be able to say that they've got that in stock if anybody asks. So in their situation, their stock days are massive. That said, we've got that to a number that we're comfortable with, and providing it's around that, and it's really around the other key financial metrics to hold that in check. That is the strategy working. So so part of it can tie back to the part of that can just tie back to the overall strategy as well.
Perfect. All right. Well, like I said, we're gonna send everybody that 13-week cash flow forecast. If anybody needs any help at all with that forecast or are looking for a long-term forecast, please don't hesitate to get in touch. And thanks so much for joining the webinar today. Thanks.
Cheers.